Hello, and today is Wednesday, the 25th of April, 2012. Let's take a look at today's gold and silver charts. The time is not 22 minutes after 0, we've got GMT. This is the data from 10 o'clock. It's now 10:45, and what we have in here is a significantly amount of lower highs. 4 of them. So this is the first one, and then 3 that has followed ever since. The pattern of lower lows looks as if, well, it could still go through. If this low here comes in and makes a new low, then that's just going to change, but maybe it's making its first higher high. Very difficult to state, but either way, if that's the case, it's a symmetrical triangle, because now we can make a trend line, and then, of course, you got that significant one there as well. Indecision is really what that states. But as far as what Fibonacci analysis is concerned, when you reach a significant Fibonacci level for the first time, which was the case in here, then usually you find some sort of bounce. This move is some sort or one of the sorts of the bounces, and it came close to the significant Fibonacci line. So if you were to buy at 1620, looking to sell at 1683, boy, doesn't that suck, because it came close, but not quite. But that's still close enough to be a Fibonacci hit. If you're looking to sell at 61.8% from this high, then it would have obviously been a successful hit. But the second time, one, it's not as strong, that support hits, and if you were looking for 61.8% from this move to this move, then this time I'd be looking for 38.2% from this high, and well, that would be in around a little higher than where we are now. But the whole point is that the more often you test these levels, the more likely it is that it takes it out. And when you look for things to be a bull market, you really need to see this thing get above this moving average where the lowest point is above the high. That's really what you're looking for, sort of like you see here, and throughout this whole duration in here. And when you have this uptrend within a correctionary phase, then that oftentimes can mean that you're just going to extend the gains. Now, it did extend the gains in here, but that was the top. And yeah, now today at 2 p.m. Eastern time, we have Mr. Ben Bernanke speaking, and I don't know if I should use the word Mr. Ben Bernanke or Master Ben Bernanke. For the definition of slavery is the state of one bound in servitude as the property of a slaveholder or household. And when I look at fiat currencies and really central banks, it does seem 100, maybe 150% accurate that we are enslaved to fiat currency. After all, if you open up any type of business, you gotta sell in dollars, fiat currency. If you get some sort of traffic ticket, speeding ticket, parking ticket, or whatever, you gotta pay your fine in fiat dollars. If you get employment, again, fiat dollars. So the volatility should be, of course, quite high. We're going to get back into gold at the end of this particular video. But now let's take a look at the silver charts. This is the daily chart for silver, and I went over this quite a bit. I am still waiting for 30. That's pretty much it. Waiting for in here for 30 to be tested, and maybe when Ben speaks today, we're going to see that $1 down move that brings it there, and then maybe it's a dollar up move, but overall the volatility within what we're seeing with low volatility. When you're having Ben Bernanke speak, that increases volatility, but volatility is already low, then it usually shouldn't be all that large. When we switch this up into the weekly chart, again, if a 30 level holds as support in or around that area, then what you'd be pretty much be developing is a cup and handle formation, which would be the cup and then the handle, and then of course breaking out above this level is extremely bullish, because This has been tested on 2 occasions. It would be a third significant test. The more often you test it, the more likely it is to take it out. But on the contrary, breaking down below 30, going down to 26 is also the third test on this bottom level. Okay. Now let's take a look at this on a more longer term, which is the quarterly term time frame. And when we look back at the charts, what you need to see is the moving averages to be rising, price action to be above it for it to be bullish. So down in here, you can't see the averages, but obviously it was in a downtrend. Nothing bullish about that. Tries to break above in here. Look, this is that great failed breakout of 1997. But it didn't hold support really at the 18 average of closes. See, when you break above it, I don't mind finding support at the 18 average of highs like we're doing because that's bullish, or even the 18 average of closes, but the 18 average of lows, no thank you. So back in here, when it was unable to hold this line, then that was telling you that it wasn't ready for the market to get going. And it really didn't have much of a failed move, but actually this was a failed breakdown. So I guess the failed move created another failed move. And here, when you broke above it, this was the first time since really in here that the lowest point was above the 18 average of highs. But you also had this previous level of resistance at the time that it needed to get above. And you can see that it tested it for quite some time. So as it was breaking in here, if you look at this now in hindsight or after the fact, it was such a great time to go long. Well, that's really the message of technical analysis, is this is the type of setups that you're looking for, key resistance points, and then boom, as you can see, it was going well from there. Now, as we're looking at this today, we still have yet to make a lower low, actually. It's a higher low if it continues to go higher. The last time that we made a lower low on this chart would have been the bottom, however, because the previous low in here was taken out in 2008. But then what did that mean that we made the lower low? It meant that we had the failed move. So maybe it breaks this low, comes down here, and it's going to do the same thing again. It's very difficult to point out. I do know that if we do break down below 26 and test in the area of 23 down to 18, that we're going to have a major physical disconnect within the commodity itself, and it would be surely interesting to say the least. There's no guarantee that it's going to go there. You could wait all you want for $22 silver. You may get in, but then again, you also may not. Now let's just finish this off and let's talk a little bit about gambling, because I don't know what the law books state, but obviously gambling's illegal. But let's just look more into depth of what's illegal, because apparently I guess it's legal where as long as you don't bet money that you can make wagers, just, oh, you gotta wear this shirt at this one event if you lose a bet, all different things like that. But the whole point is if it's gambling illegal based on money, then is it legal without money? After all, it was in 2011 when Dr. I guess I should say, Ron Paul asked Mr. or maybe Master Ben Bernanke if gold was money, and he said no. So I just thought of an idea yesterday. If I were to basically have a web page, maybe something like goldbet.com, would that be illegal to have wagering in that of gold? Instead of betting fiat dollars, you're betting milligrams of gold. Instead of playing a poker tournament where it's a $10 buy-in, maybe it is a 200 milligram buy-in type of a deal. But even within sports, I want to come up with a little idea now as far as free market sports betting. Let's take the first game of this upcoming NFL season. It's going to be the Dallas Cowboys against the New York Football Giants. So if we decide that we want to have a free market, that means as a owner of a casino site like this, you would never ever take a sports wager. You would just host them. And you let the free market decide what the line happens to be. So let's just assume one person comes out and this person wants to bet on the New York Football Giants. And he wants to lay 2.5. So bet on Dallas. So he's going to offer you Dallas plus 2.5 because he wants the New York Giants. So now the next person comes in and he says, "Okay, I want to bet on Dallas, but I kind of want 3 points." So we put in bet on New York Giants, and the line for that is New York Giants -3. So now if someone next was to come in, if they wanted to bet on Dallas, then they would have to take the plus 2.5, or they would have to make their own line themselves. If you wanted to bet on the Giants, you would have to go Giants -3 or make your own line itself again. So let's just assume that I wanted to bet on the Giants, but I kind of want to change the line again. So I see someone has 2.5. So what I'm going to do is I'm going to put in Dallas +3, but I'm going to give them a little bit of an advantage, and that the line is plus 110, which means that it's minus 110 if you want to bet on the New York Giants, which actually doesn't make sense. So let me just change that up to, that would make sense. Because normally when you have markets, or sports gambling, each side puts up minus 110 and the casino takes the vig. But if one was to bet on this betting gold, would it be illegal? After all, it's officially, according to the master himself, Ben Bernanke, not considered to be money. So would that be legal to allow people to bet on sporting events via that of other things that are not money, like gold and silver? I would find that a little bit interesting, to say the least. So now let's move back onto this. So one person puts in Dallas plus 2.5 plus 110. So now someone comes in and says, you know what, I'm going to take this bet. Let's just say the original person was willing to risk 2,600 milligrams of gold. So he put in 2,600. But this person only wants to bet 1,500 milligrams. Well, what would happen is 1,500 of the 2,600 has been taken into play. Only 1,100 milligrams are left. Okay, so another person comes in and wants to make that same wager, but wants to bet more. He wants to bet 1,500 milligrams. So he has taken the 1,100, but he wants to get 400 more. So he's going to be going on this side in here, and he's going to be offering wagers on the New York Giants at minus 2.5 and minus 110. And this is how the natural line moves would change. Let's look at a larger example. Let's just assume that you got a game between Minnesota and Chicago. And let's just talk about over-under for this one. You can bet the total points for both games. Let's assume that it's been, people can bet over, let's just say it's 36, and the under is 35.5. Let's just assume now some severe weather forecasts have come in, and the winds are going to be in the area of 60 miles an hour. Yay! Now everybody and their grandmother is going to be betting on the under. Now normally what you'd end up getting is you'd have 65-70% of the people betting under, and the sports book has taken action. In this, 50% have to bet over, 50% have to bet under, because you need someone to accept your bet. Now what a free market would do is people, let's just assume you have all of these different people putting bid offers, like the stock market. Someone just scoops them all up. So now they just took every single one of these up, and you cannot even bet on the under because someone just bet them all. So now someone's like, okay, if that's the case, I'm just going to put a 32.5 in there because I think it's going to go over still. But interesting how everyone's betting the under. I'm going to say I want to go over 32.5, and then whoever's got the 36 is going to be like, screw this. That's just no action's going to be taken. And next thing you know, the free market's going to be bringing that down. That's really exactly how the stock market pretty much works as well. At least a free, pure market of it. So that's why when I talk about how the markets should trade, is that you have options. If you own silver, you can sell it with anybody who's got an order in to buy, or you can put an order in for somebody who wants to buy. And of course, if you want to buy, you find somebody's order, you take it, or you place an order yourself, and then that would let the free market decide what the price is. However, we're living in a world where we have all of these fancy financial instruments, all these different options, all this leverage, and shorting the market, all this mumbo jumbo that, in my opinion, is totally unnecessary, that makes the volatility so much larger. But this is, again, just my personal opinion within the matter. Thank you for tuning in, and have yourself a magnificent day. Bye-bye.